We expect dry bulk market demand and supply balance will be stable in the coming years. However, our data-driven forecasting models predict freight rate will face correction and decline by 30% in the coming quarters as vaccines become more widely available and reduce COVID-19 impact. This is Daejin Lee, lead shipping analyst in IHS Markit. In this video, I will discuss key development of dry bulk market with special focus on COVID-19 impact. In the freight rate forecast, demand and supply outlook, IHS Markit predict that the global dry bulk trade will increase by 3.2% in 2021, mainly driven by coal and minor bulk trade. It will continue to grow by 5.8% in 2022 and 2.7% in 2023, largely supported by global economic recovery related industrial material and agricultural goods. While dry bulk fleet growth will remain 2 to 3% in the next 3 years, although some ship owners have exercised options of existing newbuilding contract placed in previous years with much cheaper prices, we observe that total order book has never been high compared to historical level, especially with the uncertainty of several environmental regulations, including carbon dioxide emission controls. It is becoming very difficult to have a new building order in the coming months. For steel, mainland China's electric arc furnace capacity is expected to increase from about 10% in 2020 to about 15 to 20% of the total steel production capacity in the mainland China by 2025 to reduce carbon emission with its ongoing supply side reform to limit the overall crude steel production volume. At the same time, blast furnace steel production with iron ore is projected to increase very marginally or potentially decline in the coming years. However, in our view, iron ore will remain as a main source for steel production in the coming years, despite China's increased consumption of steel scrap for steelmaking. Especially, we expect Brazilian iron ore expected to grow by 13.2% in 2022 once the pandemic and license-related supply constraint issue have been resolved. Agricultural shipments are also expected to grow in the coming years. Soybean trade has been slow in 2021, mainly owing to limited end stock, but trade growth will continue to grow from 2022 to 2023 as mainland China will increase its meat consumption with continued urbanization. Corn trade is also expected to increase during 2021 to 2023, mainly from the US and the mainland China route with the trade deal earlier last year. Global wheat feeding could also increase owing to lower availability and high price of corn and soybean in the major origin. On the contrary, we believe that peak coal trade have ended in 2019. With the recovery in energy demand and high gas prices, thermal coal demand is expected to remain strong in the next 2 years, but will decline eventually thereafter, in line with global energy mix shift. Environmental policy that favor renewable and gas over the thermal coal, and also favor scrap over the coking coal and iron ore, will giving more widely available coal demand is going to be down. Metallurgical coal trade linking to steel production will recover from its 2020 level and grow in 2021 and 2022 by 5 to 7% every year, but annual growth will start to slow once it becomes near to its 2019 levels. We observe significant increase in the congestion and also very high volume of minor bulk shipment. Especially this is the, we believe, main cause for current status of market. Traditionally, minor bulk trade has been affected by iron ore, coal, grain, but this time, minor bulk trade is set to be the best performing commodity this year with a strong 8% growth. Traditionally, dry bulk freight rate have been supported from the top-down basis, Capesize supporting Panamax, and Panamax supporting Supra Handysize. However, unlike in the previous years, the strong performance in the minor bulk trade has resulted in supporting the larger vessel classes from the bottom to top. This is very interesting development because with the general cargo vessel, especially from East Asia, including mainland China, South Korea, Japan, and Vietnam, the vessel has moved to container market now. Especially convertible breakable cargoes from container sector, including cement, fertilizer, chemicals, minerals, and steel product. Recently, general cargo ships and also geared small bulkers picking up those container-related cargo. There has been very high market on this traditional bulkers backhaul rate. As you can see in the right chart, backhaul dry bulk rate is almost identical with container rate. Therefore, the key assumption for dry bulk freight rate outlook is also need to be based on container-related backhaul route for geared bulkers, and this route will hugely depend on pandemic and vaccination development. We expect as vaccine reduce COVID-19 impact, overall consumption and energy demand as the global economy will recover will also increase a lot, but this could be countered by decreasing port waiting time, and also service sector consumption will recover and reduce physical consumption, including online shopping. This may reduce actual physical container trade and backhaul dry bulk trade demand. A lack of stimulus from mainland China and returning focus to environment policy that favor gas renewable and scrap over coal and iron policy would be also major downside risk once vaccine become more widely available in the world. Therefore, we are more bearish with vaccine impact in the freight rate market, and also in the medium and long-term base, vaccine impact will reduce COVID-19 impact, which also reduce freight rate in the longer term. However, in the same context, in the short term, the ongoing pandemic and record high backlog would become a major upside risk on freight in the first quarter and early next year. Thanks for listening. This is Daejin Lee from IHS Markit.